We're going to continue our discussion on Chapter 7 with Section 1231, Business Use Assets. So as we talked about at the beginning of Chapter 7, Section 1231 assets are those that are used in a trade or business and held for greater than a year. Gains and losses from the sale of 1231 assets are going to be netted before tax rates are applied. A net 1231 gain is taxed as a long-term capital gain subject to recapture provisions, which we'll talk about later. The recapture provisions apply to depreciation taken as a deduction in prior years. The depreciation recapture rules are designated to transform some or all of our 1231 gain, which is a long-term capital gain, into an ordinary gain that's taxed at the regular tax rate for the taxpayer. So our net 1231 gains are going to receive preferential tax rate treatment as long-term gains. Net 1231 losses are going to be treated as ordinary losses, but they are not subject to the deductibility limitations of $3,000 per year that individuals are subject to. Section 1245 applies to personal trade or business property and is a subset of 1231 property. This is the recapture provision. The tax rate to recapture the depreciation portion of a gain is taxed at ordinary rates. Any gain that remains is going to be taxed at the preferential long-term capital gain rates. Section 1250 recapture will apply to buildings, residential or non-residential, meaning commercial, and is a subset of 1231 property. The amount of the gain of the capital gain attributable to depreciation previously taken is going to be taxed at the 25% rate up to the depreciation amount considered unrecaptured. Remaining gain, if any, is going to be taxed at preferential tax rates. So let's take a look at an example of a business use, a 1231 asset. We have Lee, who purchased depreciable business equipment for $50,000 2 years ago. Since then, $35,000 of depreciation has been deducted on this equipment. So what's the equipment's adjusted basis? The basis will be the cost minus the accumulated depreciation. So $50,000 minus $35,000 gives us an adjusted basis of $15,000. If Lee sold the equipment for $45,000, what would his realized gain be? So the realized gain would be the sale price of $45,000 minus the adjusted basis of $15,000, which would give us a realized gain of $30,000. What part of the gain would be treated as ordinary income? Well, since there has been $35,000 of depreciation deducted on this equipment, up to $35,000 would be recaptured as ordinary gain, as ordinary income. So in this case, the entire amount of the realized gain on the sale would be taxed at the ordinary income rates, so $30,000 as ordinary income. Now this scenario is a little unlikely because depreciation will normally lower the value of the asset, so it would be unlikely that we would actually be able to get $45,000 for this asset, that it would be worth that much. So now we're going to move on to some special types of sales. Sales of stock that are purchased of blocks of stock at different prices or at different dates are valued either using specific identification or the first in, first out method for determining the basis of those stocks. If the shares of stock are purchased in a mutual fund, those are pools of resources from various investors and purchases of shares of stock in our portfolio. An investor in a mutual fund will receive a Form 1099 dividend that is sent annually to the individual investors in the mutual fund to record any dividends, capital gains, and distributions from the fund for the year. Capital gains that are distributed from those mutual funds are going to be reported on Schedule D or directly on Form 1040 if the Schedule D is not required to be filed. There are three methods to calculate the basis of shares in a mutual fund that's purchased throughout the period. The first in, first out assumes that the first shares purchased are the first shares that are sold. The specific identification method assumes that the shares that are sold can be identified with a specific purchase. And then we have the average basis, which calculates the average of the shares purchased for a period and uses the average to determine the cost basis of the shares that were sold. If a taxpayer has securities that have become worthless during the year, those are going to be treated as losses from a sale or an exchange of a capital asset on the last day of the taxable year. Declaration of bankruptcy by the company whose shares are held is not sufficient to indicate worthlessness, because during the bankruptcy process, some of the shareholders may recoup some of their investments. It's often difficult to pinpoint exactly when a security becomes worthless to determine a sale date for long-term versus short-term treatment. So that is why that all worthless assets are going to be treated as disposed of on the last day of the taxable year. Another type of special sale is the sale of assets that were given as a gift. There's some different valuation rules that apply to assets that were received as gifts. If the fair market value is less than the donor's adjusted basis at the time of the gift, we're going to use the donor's adjusted basis for a gain. And we're going to use the fair market value if there was a loss on the sale. However, if the sale price is between the adjusted basis and the fair market value, then there is no gain or loss on the sale. If the fair market value is equal to or greater than the donor's adjusted basis at the time of the gift, then we're going to use the donor's adjusted basis for either a gain or a loss when that asset is sold. So let's take a look at an example. We have a taxpayer who received a cabin as a gift. The fair market value is $90,000 and the donor's basis is $100,000. If the cabin is later sold for $120,000, the realized gain is going to be $20,000. The amount realized, $120,000 minus the basis of $100,000. If the cabin is sold for $80,000, the realized loss is going to be $10,000. The amount realized of $80,000 minus the basis of $90,000. If the cabin is sold for $95,000, there'd be no gain or loss recognized on the sale of that asset because the sale price is between the fair market value and the donor's basis. If property is inherited, the basis to beneficiaries is going to be the fair market value at the date of death, or there is an alternate valuation date that can be used. The holding period is always going to be considered long-term. So, for example, if there is property that was inherited with a basis of $3,000 and it's sold 6 months later for $4,000, the $1,000 in gain would still be considered long-term and would qualify for preferential tax treatment because it is an inherited property.